know that variable rates at 1.4% are cheaper, of course. And there's a chance, that they can go up even higher than 2.6%. Sometimes in the next 5 years, not right away, but even when that happen, even if they go that high, that does not like necessarily like means fixed rates are better choice. Better way to look at it at is to look at the total average like rate over the entire term, like a 5 year term. See the 5 years average rate, how much is variable and how much is right now the fixed is. Well, actually, be like a higher than fixed rate at 2.6%. You think a variable will go more than 2.6%? No, I don't know. To get that, it's take a look what's like happening in the market here. Let's say rate are expected to go up in 2022 by 20 basis points one time, then a 25 basis point the next time, then 25 basis point in the last quarter as TD Bank, and they are expecting and all those things. Let's say it's totaling about 75 basis point gone up, which means the overnight rate will go from the current like a 0.25% to like a 1%. So by the end of 2023. So beyond that thing might get like a more I don't know. So let's see what happened. Depending on the how inflation and COVID-19 variant and all these things, happens. So the Bank of Canada comes up with kind of a neutral rate every year. Like they go according to inflation and all those things to keep control on it, which shows like what to expect. Overnight rate should be like maybe it is the economy goes back to normal and inflation is on the target. Let's see after some time. In their latest report they estimated, I think the current like neutral overnight rate would be like in average from 1.75% to 2.75%. In other words, if overnight rate ends up being at a lower rate of like let's say 1.75% at end of the 5 year term, we are going to see is like like similar like 150 basis point of rate hikes on variable rates. Let's keep things simple and assume a more linear increase like starting 2023. And when we do this, we will find that the average variable rate over the 5 year term would be 2.3%, assuming a 150 basis point rate hike. Now, now we compare this to the current 5 year fixed rate, which is 2.6%. So that means variable rate are still better than 2.6%. But like if rates go like end up being in the upper bound, like being a Canada neutral rate, still like then what it will happen? Variable rate will go up to what 250 basis points instead of 150 whatever. So we will be locking at an average 5 year, looking at average 5 year variable rate at 2.7%. In other words, choosing a variable rate at 2.6% would be better. Remember, there's extremes. So perhaps we can try to see like what will happen. In the most average cases, like a case at the midpoint of the neutral like a range, midpoint rate hike is like a 200 basis point. And if that happen, if it goes 200 basis point up, the average variable rate will be about 2.5%. That's what happened. And this will still be less than the current fixed rate, which is 2.6%. So now, of course, this is just based on what the Bank of Canada projects, like what their projections are. So if you don't buy their projections, then we can try to look at things another way by just looking at a history in 80s. We suffered, through a like big recession, and in the highly, kind of there was a lot of issues, and GDP was really down, and unemployment was very high, like a very, and inflation was skyrocketing, there was a lot of issues. And it did not, end until early 90s. So when the Bank of Canada, they took inflation head on. So that's the time it came down. And so thing finally started like come down, and back in about starting and stabilizing in end of 1996. And that's when overnight rate dropped back down more neutral level. And that we're used to seeing at around 3%. And then over the next 3 years, overnight like a rate like rose to 275 basis point before like peaking Y 2000, 2000 thing, when the rates had to be brought back down because of due to like a dot-com bubble. Yeah. Then let's look at the next cycle. When things started recovering in 2022, so in the year of 2022, and then eventually peaked in mid of like 2007. Over those 5.5 years, overnight rate went up to a total 250 basis points before the final crisis hit. Then the final crisis caused overnight rate to drop back down to record like kind of lowest level of like it was 0.25% in the spring of 2009. The market was still fragile, and so rates tried to go up by 75 basis points for a few years. But then they had to come down in mid 2015. So technically, from 2009 to 2018, a period of 9 years, rates were only went up 150 basis point in total. So if you average those out, the average rates hike of those cycles was around 181 basis points, which is lower than the Bank of Canada's midpoint neutral rates. And if that happens, we know choosing variable rates will be better off compared to fixed rates. Now, besides choosing the lowest expected rates, another thing you should consider, which is also very, very important, are there are additional risks. On one hand, like variable rates do have added risk. The rates can go up a lot more than what we are expecting. So that's definitely a risk. And in that case, the fixed rate is definitely safer. But at the same time, you also have to understand that there's more than this. Fixed rates have the higher penalty risk. This is another issue. It's all depend how long you're going to stay at the property. You're not going to break the term. And this is very important. If you think you might break mortgage before the term ends, the penalty of variable rates mortgage are generally calculated based on 3 months interest, variable when you have that mortgage. But breaking a fixed mortgage is totally different. That might even much higher penalties because they are subject to interest rate differential calculations. So let's take a look at like what's this mean. Right now, the break even point between the 5 year fixed and 5 year variable rates is is a rate hike around 225 basis points. So if actual rate goes up by less than 225 basis points, then variable rates are actually better. If actual rate goes up by more than 225 basis points, then fixed rates are better. But this can change at any time. So let's say market sentiments shift and 5 year fixed rates fall by like 50 basis points. You might face higher penalties if you break a fixed rate mortgage because if it's dropped by 50 basis points. Let's say if you have like a 4.5 year left on your like a mortgage is locked at about 2.6%. For mortgage is about $800,000. Just calculate this way. Then the current rate, posted rate, is dropped by 2.1%. If the break fixed rate like mortgage, if you break it, you will have to pay a penalty of $18,000. But if you went with the variable mortgage instead of fixed, you do only pay like 3 months of interest, which is at like 1.4%, which will be lower than $2,800.